Now, before moving ahead, I should make one distinction very clear. Short selling is a beneficial and legal practice, permitting the short seller to profit from declines in a company's share price. Any one of us could do it if we chose to. Short selling, however, is not the same as buying put options. However, both are means of profiting from declines in a stock's price. Naked short selling is a name often applied to an illegal, steroid-enhanced perversion of short selling, and is the most common mechanism by which stock manipulators generate supply-swelling IOUs to sell instead of real shares. Neither you nor I could do this, but until relatively recently, a few powerful folks on Wall Street could and actively did engage in naked short selling in order to manipulate the price of a company's stock down, making their regular short positions and put options much more lucrative. If the distinction between short selling and naked short selling is not completely clear, or if you'd just like to learn more about it, check out businessjive.com. Whoever bought those Bear Stearns put options was almost certainly also responsible for naked shorting the price of Bear Stearns stock from over $60 a share to under $5, such that a $1.7 million long shot turned into a $270 million windfall in a little over 1 week. That's a return of 8,000%. And at what cost? Well, some things we can quantify and some things we can't. Among the things we most easily can quantify, it cost billions and billions of dollars in shareholder wealth, 29 billion taxpayer dollars used to guarantee the eventual shotgun wedding between Bear Stearns and JP Morgan, and the jobs of several thousand Bear Stearns employees. But that's barely the beginning, because the criminals, which is what stock manipulators are, managed to get away with it, and the cost of that may never fully be realized because, as everybody knows, when a criminal gets away with their crime, it's certain to happen again. And indeed, it did. But not before the United States Senate Banking Committee met in early April of 2008 to figure out exactly what happened to Bear Stearns. The hearing was held days after Bear collapsed, lasted 4.5 hours, but could have been boiled down to a pair of questions, both posed to Christopher Cox, who was chairman of the SEC at the time. The first came from Senator John Tester from Montana.
Chairman Cox, has anyone brought to your attention, or do you know of the possibility of short selling that helped bring down Bear Stearns?
I want to be careful in the way that I respond to your question. It is a perfectly appropriate question. It deserves a straight-up and factual answer. I'm a little bit constrained because the SEC is in the law enforcement business, and I tried delicately to answer that question before. The SEC very aggressively pursues insider trading, market manipulation, and the kinds of illegal naked short selling that have been very publicly alleged in this case.
Okay. Thanks. I'll interpret that answer the way I think everybody else in the room interprets it.
And the second from Banking Committee Chairman Christopher Dodd of Connecticut.
But I was struck. I went back and looked at the volume of transactions. I guess, Mr. Chairman Cox, I'd like to address this to you if I can. I was looking at the volume of transactions. These looks like historic volume. I'm looking at the amount of transactions that occur daily, weekly, transaction on a daily basis. The numbers run at Bear Stearns running up to this week. 3 million, 5 million, 6 million, 8 million, 7 million, 2 million shares. Roughly those numbers. You get into the week of March 10th through the 14th, and the volume jumps to 32 million, 54 million. 26 million. On Friday, March 14th, 186 million. A substantial jump in volume. I'm also intrigued about the 30-day puts, the $30 puts, excuse me, over 10 days. There seems to have been a rather significant. In fact, someone ran the math on it for me, and if you made a $600 investment on Thursday in Bear Stearns, on Monday that was worth about $37,000. Not a bad deal to make. To what extent is the Fed looking at this? Not the Fed, the SEC. And I understand you answered the question earlier. You can't comment on investigations. Let me put it this way to you, I guess, Joe. I mean, I would hope that you're looking at this. And to the extent this kind of spike that occurs here would seem to be must have triggered some sort of bells and whistles at the SEC here. This goes beyond rumors. There's no there's no violation in law about rumors. There is about collusion. and when I look at a 10-day and 30-day puts, I wonder what's going on here, and whether I see this spike, it at least raises bells and whistles in my mind what's going on. And I guess I can ask you this. Did your agency react to this at all? Was there a reaction going on that week to these activities?
Yes, Mr. Chairman. Your hopes will be, I think, met and exceeded with respect to the agency's response to these concerns.
Well, there you heard it. The good news is Cox committed the SEC's Enforcement Division to actively getting to the bottom of the illegal naked short selling that was so obviously responsible for crushing Bear Stearns' stock price. The bad news is this is the same SEC Enforcement Division that spent the better part of a decade actively ignoring plain as the nose on your face evidence of Bernard Madoff's epic scam. The same Enforcement Division that, according to a United States Senate report, wrongly fired SEC investigator Gary Aguirre when he discovered evidence of insider trading by someone Aguirre's superiors deemed too politically powerful to charge with the crime. The same SEC Enforcement Division that has failed to bring a single action against anybody for naked short selling. Based on that track record, you can probably guess what happened. Nothing. And with the expected results, the naked short sellers struck again. This time the target was Lehman Brothers. The actual attack appears to have been planned to begin at the end of June in 2008, specifically on June 27th. That's the day millions of IOUs generated by naked short selling of Lehman stock began pouring into the market, shearing 40% off the company's stock price in just 2 weeks. By now, even the SEC was beginning to get the message. Manipulative naked shorting was a tool used by criminal short sellers to destroy public companies. And, barring something extreme, Lehman, Fannie Mae, Freddie Mac, and others would undoubtedly be next. Perhaps sensing the economic Armageddon on the horizon, on July 15, the SEC announced its intention to temporarily enforce rules meant to curb the already illegal practice of naked short selling, but only in the shares of 19 banks. As the SEC's press release said, today's commission action aims to stop unlawful manipulation through naked short selling that threatens the stability of financial institutions. Immediately, the share prices of Lehman and the other 18 protected companies began to recover as naked short selling of their stock all but ended. But any sense of relief was short-lived as it became obvious to anybody paying attention that the SEC barely even understood what naked short selling is. At least such was the message transmitted loudly by Chairman Cox in this interview on Fox Business Network.
There, I guess you could say, is a growing rumbling that the SEC has not been doing its job in terms of enforcing naked short sellers and the rumor mill. How do you respond to those comments?
Well, it's a very nice opportunity to explain the mistake that your previous guest made and that a lot of the media are making right now in assuming that naked short selling is illegal. Everybody knows they don't like naked short selling. They assume, therefore, it must be illegal and against the rules in all circumstances, but that's not the case. And as a matter of fact, in the financial sector, in these largely capitalized and big float firms where you can locate shares rather easily, the opportunity to extend a fail well beyond 3 days, well beyond weeks, indefinitely currently exists. We want to make sure that that tool for manipulators, and that's what it is taken away. We are not at all interested in tamping down on legitimate short selling, but what we are after is this sort of witch's brew of the manufacture of false information and then driving the price of the stock down, not through normal laws of supply and demand, but through the manufacture of shares that don't exist, and that's what naked short selling